PDF what?
127. Limited company, yeah.
127, right? Public limited companies. This form of business organization is most suitable for very large businesses. Most large, well-known businesses are public limited companies, as they have been able to raise the capital to expand nationally or even internationally. As long as the private limited companies think about expanding, so it's important it goes public. And to go public means you have to start selling your shares in the stock exchange. So why do a business would want to go into a public limited company? Why would a business want to be a public limited company? A business would like to be a public limited company because it is the only way it could get, capital that is not limited. Unlike a private limited company, the capital employed in the private limited company is restricted within friends and family. But here, you can issue shares to the public. That means you can raise as much as possible. But the only issue is that when you are raising more capital into the business, you are also losing control of the business. Because the more shares you sell, the more fund that comes to the business, and the less control you have. That is public limited company. Do you get that?
Yes.
So students often make two mistakes about public limited companies. Public limited companies are not in the public sector of industry, as many students believe. They are not owned by the government, but by private individuals. As a result, they are in the private sector. So most of people make mistakes about seeing public limited as a public sector business. It is not. It is a private sector business because it's controlled by individuals and firms. And it also sells shares. Why we call it a public limited company is because it can sell shares to the public. It doesn't mean it's owned by government.
Yes.
So the title given to public limited companies can cause confusion. This is why in the UK, public limited companies are given the title as PLC after the business name. For example, J. Sainsbury PLC. In other countries, the title limited is used. This must not be confused with the UK use of limited, which refers only to private limited companies. In the UK, they have LTD, and even Nigeria, we use the same system as UK. There's LTD for like your dad's company. It's a limited, the name of the company, and LTD at the end of the name. That's the initial, but when it becomes a public limited company, the initials be PLC at the end of the company.
Yes.
I think it's clear. So yeah, it's just about the companies and different companies we have. So we'll go to a public limited company has certain advantages and disadvantages. So we'll go to the advantages. So go to advantages now. Advantages and disadvantages of public limited companies. The first advantage is this form of business organization still offers limited liability to shareholders. So shareholders are not going to lose their personal wealth or property or assets in case of bankruptcy. They're not going to lose it. But the only thing they're going to lose is their investment into the business. Clear?
Yes.
So it is an incorporated business and has a separate legal identity to the owners or shareholders. Its accounts are kept separately from those of the owners, and there is continuity should one of the shareholder dies. So here, another advantage for a public limited company is that it has a separate legal entity, which means the account of the business is run separately from the account of the owners of the business. As a result, whatever happens to any of the shareholders or the owners of the business will continue to run because it is not unlimited liability.
It has its own personal.
Yeah, fair. The third advantage, there's now the opportunity to raise very large capital sums to invest in the business. There's no limit to the number of shareholders a public limited company can have. So because you don't have a limit, you don't have a maximum of numbers that you could have as shareholders. So it means you have unlimited capital injection into the business, which is an advantage. The next one, there's no restriction on the buying, selling, or transfer of shares. Unlike the private sector. In the private sector, all shareholders in the private sector must agree that these shares has been transferred to certain individual.
Oh, so they can sell it or buy it, yeah.
Yeah. So, but for public limited company, even the company does not have authority over who you sell your shares to. Though there's always what we call share redemption, where you have to buy back your shares. But that's in accounting, A-level accounting. We call it share redemption. So there, if it's going to happen, it would have meant that the company itself have had agreement with those that bought the shares that at a certain period of time, we're going to buy back our shares. We call it share redemption.
Yes.
So this also happens if the company has enough in its reserve. That's accounting.
In the general reserve.
Yes, general reserve. Clear?
Yes.
All right, so that's about transfer. Then the last one here, it said, a business trading as a public limited company usually has high status and should find it easier to attract suppliers prepared to sell goods on credits and banks willing to lend to it other than other types of business. As a public limited company, you are big, you are huge, you've got a reputation. So you are credit worthy. That is the point, that you are credit worthy. As a result of that, suppliers will want to sell with you. Suppliers want to associate with you. They want to link up with you because they know their money is secured and safe with you. Banks want to lend you money. They want to do business with you because they know that you always pay back. You are not a high risk. Is it clear? So that
means that public limited companies like the advance of a private limited company.
It's an expansion of them.
So every public limited company has they don't have that risk.
No, all businesses have risk. All business. Let's look at the disadvantages now.
Yeah.
All right, the first disadvantage, I told you, the first thing is this. As you become a public limited company, you start losing the ownership because you're selling shares to people. So, as soon as you're selling shares, the number of shares you held reduces.
Yes.
So now let's go to the disadvantages now. The first one, the legal formalities of forming such a company are quite complicated and time-consuming. You have to prepare your article of association, memorandum of association, and it has to go through the registrar of companies. This takes time.
Yes.
2, there are many more regulations and controls over public limited companies in order to try to protect the interests of the shareholders. This includes the publications of accounts which anyone can ask to see. So there are always, checks and balances in the public limited companies because they have government institutions, they have to protect the interests of the shareholders because they are investing in a company that they are not going to be the one to run it. Do you understand? So yes, their money must not be lost. As a result, it's so complicated to the extent that you have to publish your profit or your loss. Everybody has to see it because they have purchased, they have invested into the business. So they have to see how the business, they have to see the performance of the business. They will question that. Is it clear? And in the course of you providing or publishing your company's performance, your competitors will see. They'll be able to weigh or measure your performance with regards to theirs. Yes. The next one. Selling shares to the public is expensive. The directors will often ask a specialist merchant bank to help them in this process. It will charge a commission for its services. The publication and printing of thousands of copies of prospectus is an additional cost. You have to prepare a prospectus, which is just like a form, letting them to understand the benefit of buying shares with you. So that's what they're going to see first. You have to issue a prospectus, telling them what the prospect of investing in your company's shares are. That will convince them to buy. So you have to print a lot of papers. These are expensive. Yes. Do you understand? Yes. And you have to pay the banks that are going to sell. You are not going to be the one to sell your shares. It will be bought from the banks. Banks are the ones that sell shares. Yeah. It's your shares. Okay. But it will be sold through a third party, which is the bank. Okay. People will not come to your company. How big is your company? You want them to come and queue and start paying you now? It goes through your bank account. Clear? Yes. So okay, but you pay banks for that, for the service. Okay. There's a very real danger that although the original owners of the business might become rich by selling shares in their business, they may lose control over it when it goes public. This is an important point which we will investigate further. So the next disadvantage is that as soon as you sell shares, more money comes. Control is losing. You lose control. It's an opportunity cost. You can't. There's no other choice. It's a trade-off. Sorry, I would prefer to use a trade-off.
Trade-off.
Yeah, which means money comes, ownership is ownership lost. It's a
Trade-off.
trade-off. Clear.
Okay, yeah.
So this takes us to control and ownership in the public limited company. Are you there? In all sole trader businesses, and partnership, the owners have control over how their business is run. They take all the decisions and try to make the business achieve the aims that they set. This is also the case in most private limited companies, which have relatively few shareholders. Directors are often the majority shareholders, so they can ensure that their decisions are passed at all meetings. So, sole trader and partnerships, they have control over their business.
Yeah.
But when it comes to public limited company and private limited company, the directors take charge, though, especially for private limited companies. The owners are the directors, so they take charge. But for public limited companies, they employ directors. They employ directors that work for them, which they can dismiss at any point in time if it's not performing. He or she is not performing. You get the point here?
Yes.
And they do this through their AGM, annual general meeting. So if they have to employ directors to the company, they do that during the annual general meeting. Is it clear? And that's where they also declare the profit made by the business and to talk about the dividends that have to be paid to the shareholders.
Yes.
Clear?
Yeah.
Control and ownership in the public limited company. I'm going down. Control and ownership in the public limited company. So the shareholder own, but the directors and managers control. I said that already, right?
Yeah.
I said it already. Now, does this matter? It might be important for the shareholder. It means that the directors and managers may run the business to meet their own objectives. This could be increased status, growth of the business to justify higher management salaries, or reducing dividends to shareholders to pay for extension plans. The shareholders are not able to influence this decision. So, shareholders. The point here is that managers and directors might have different objectives to those of the shareholders. Shareholders want return on their investment. So they want more dividends. One thing is this: shareholders do not have the right to talk about increasing dividends,
They don't have the right.
but they have a say when it comes to reducing dividends.
Yes, I get it.
Clear? Okay. So basically what we're talking about here is that shareholders' objective might conflict with owners' objectives, managers and directors' objectives, because directors' objectives might be like expanding the business, because as soon as the directors are able to expand the business, more money for them, more salary for them, because it means that they are performing well. They will ask for raise.
Yeah.
Do you understand? So, and it gives them more reputation. When you are a manager for a big company, it's different from when you're a manager for a small company. A manager in a big company, at a big company, brings a status.
Mhm.
Do you understand? So this might be the objective of directors and managers, which is not the same as shareholders. Because shareholders might felt like if we have to expand this business, we're going to incur more cost. It's going to be so risky. We have to pay more workers. We have to pay the directors again. It might not be their objective. So there might be conflicts of objectives. Is it clear?
So what's usually the shareholder?
What?
What is the usual objective for
Shareholders? Return on investment. They want more profit. They want profit.
So it means that they want like good performance of in the company. That's it.
Shareholders?
Yeah.
Sure, that's what they want. Shareholders want the company to make more money so that they can have more return on, they can have high dividends. So that's their own objective, which we should understand because they have invested. Do you get the point?
Yes, yes.
So then, okay. The shareholders are not able to influence this decision other than by replacing directors at the next AGM, I told you. So if the directors' objectives are conflicting with shareholders' objective, the shareholders don't have any other choice than to kick them out.
Where is this?
Now, 132.
Oh, okay.
I also said that already. I told you, like, they employ directors and they kick out directors.
Oh, yeah.
But they do that during the annual general meeting. They can't do it. They don't just do it. They do it at the AGM. That's what they said.
Yeah.
Doing this would give the company very bad publicity and cause the business to be unstable, as the directors may be inexperienced. So the problem about that is that, yes, you might be able to kick out your directors, but your business might not be stable because the directors that you are bringing might not have experience in the job.
Yeah.
That's another problem about changing directors. Then we'll go down Express Tax and Boss PLC and General Meeting, AGM. I think you can see that. Are you there?
Yeah.
Okay. So it's just telling you about what an annual general meeting is about. Here they're going to declare the profit made by the business. They're going to talk about the performance of the business. They're going to talk about the performance of the directors. And if they want to appoint new directors, it's done during this time.
But they're not like talking about objectives, things of.
No, at the AGM, no. It's just about the financial performance of the business.
And dividends and.
Financial.
Yeah, yeah.
Clear.
Yes.
Okay. The risk and ownership. So let me see. Risk, ownership, and limited liability some way. Sole traders, they carried by sole owner. That's the risk. Ownership is one person. Limited liability they don't have. Partnership is carried by all. The risk is carried by all partners. Several partners, yeah. Ownership will be several partners. Limited liability, no, they don't have. For private limited companies, the risks are shared by the shareholders. Shareholders may have ownership may be shareholders, yes, and limited liability is yes. For public limited companies, it's the shareholders too. Many shareholders and it's limited liability.
Maybe millions. Wow.
Yeah, it's the public. Yeah, right?
Yeah, yeah.
So, well, we don't think.
I think we're gonna franchising and
Yeah. So we stop public limited company before the.
Yeah, yeah, yeah.
So as soon just go to the. So we don't